Hey Bowtie Nation, Joseph Hogue with your weekly market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. Folks, shares of Nvidia boomed 29% from the day it announced its stock split through last week's ex-dividend date. Broadcom, at ticker AVGO, jumped 14% in a single day when it announced its own split. Stock splits are the hot trend on Wall Street right now, and while the academics are quick to point out it doesn't change the company's value, stock prices tell a different story for investors. I'll explain stock splits, how they work, and why prices are jumping higher, then reveal 10 stocks that could split next. Stick around after that, we'll do our Monday market update with what could be the next short squeeze stock everyone is talking about, and how China is sneaking its EVs across the border from Mexico. Back to our main topic though, with Nvidia bringing back stock splits with its 29% run from the May 22nd announcement through last week's split, but investors have been buying into other splits all year. Walmart announced its split in January, seeing the stock price up 6% through the split and now up 21% since. Cooper Companies, ticker COO, was up 16% from its December 7th announcement last year to the February split, and Texas Pacific, TPL investors are loving it, with their shares up 12% over the 9 days to the split and now up 54% in the following 3 months. And I found 10 stocks to watch that could be the next to announce a stock split, so I want to highlight why splits are coming back, how they work, and why the stock prices are booming. Now understand there are actually two kinds of stock splits here, the traditional stock split and the reverse split. Now a reverse split is more of a sign of weakness and distress, trying to prop up a stock's price to avoid delisting from an exchange, so we're going to focus on those traditional stock splits here. A stock split happens when a company divides its existing shares into multiples of that amount. So if there were 100 shares outstanding pre-split, there might be 200 or 500 available afterwards. The most common splits are 2-for-1, 3-for-1, and 5-to-1 ratio. For example, pre-split, Nvidia was trading for just over $1,200 per share and completed its 10-for-1 stock split last week. Now that meant for every 1 share of Nvidia you owned before that split, on Monday you would have 10 times as many shares, and there would be 10 times as many shares of Nvidia outstanding in the market. We're going to dig into how that affects the stock price, but you can see here, last Monday, the stock opened around $120 per share, or about 1/10 of that previous price. So there were 10 times the number of shares, but the price did adjust 10 times lower. Now, there are several reasons why a company would split its shares. Increased liquidity is the most often given, where a lower stock price just makes it possible for more investors to buy in. No longer do you have to wait to save up $1,200 to buy a single share of Nvidia. Now it just takes $120 or now $130 to start an investment. Psychological impact also plays a part though. Many investors just perceive lower priced stocks as more affordable or a better deal. A stock price over $1,000 just seems expensive though. Besides the liquidity and that ability to buy more, this can also help increase that demand for the shares, those lower price shares. Also, some stock indexes, like the Dow Jones, are price weighted, meaning stocks with higher share prices have a larger effect on the index. Now that can mean $1,000 plus stocks just don't get added to those indexes because they might skew the returns, so having a lower stock price could boost the chance of a stock getting added to an index or an ETF that follows that index. And finally, a stock split is also often taken as a positive sign of confidence by management. It's really just a bit of accounting shenanigans, which I'm going to detail next, but for many, it's a positive signal to future performance for the shares, which can also become something of a self-fulfilling prophecy. Now, the way a stock split works is the board of directors approves a split and then decides on a ratio which determines how many shares are going to be created from each existing share. The company then makes the announcement public, detailing the split ratio, the record date, and the ex-dividend date for that split. Those two dates are extremely important here, just like for your dividends. If you own the shares on the close of that record date, you're going to have your shares split. The ex-dividend date, or the X date, is the first day the shares though trade on that new post-split price, so you must own the shares before the X date. Of course, the big question for investors though is, do stock splits increase the share price? Now this is where the academics and the actual investors are going to disagree. Technically, a stock split shouldn't have any effect on a stock price. Before the stock split, Nvidia had about 2.5 billion shares available in the market, with all those shares valued at around $3 trillion market capitalization. After that 10-for-1 stock split, the company now has 25 billion shares available, but has anything really happened to increase that overall value? Now, besides the almost daily march higher, nothing has really changed the fact that Nvidia is worth total about $3 trillion, so divided by the new share count, means the stock is worth 1/10 or around $120 each post-split. You can think about it this way. If you have one piece of paper, tear it up into 10 segments, the total area of that paper hasn't changed. You just have 10 smaller chunks, and that's what the eggheads say about stock splits. But we investors know differently, don't we? While a stock split announcement is no guarantee that the price is going to increase, the historical data is clear. Nvidia was up 29% from announcement to its split, Cooper Companies up 16%, TPL up 12%, and Broadcom jumped 14% on a single day when announcing its split. For the most part, stock prices do seem to rise from announcement to split and often afterwards. So there does seem to be something here to these other reasons for a stock split: the increased liquidity, index inclusion, psychological impact, and just that confidence signal that helps propel a stock price higher. And I found 10 potential candidates for stock splits to watch. For this list, I began searching for stocks with per share prices over $1,000, as well as stocks with good fundamentals. Now that is an important point here, so I want to repeat it. Please do not think that a stock split is going to make a bad company a good stock. Even if you know one of these is going to split, you still need to do your research into those fundamentals and make sure it's a stock you want to own. First up, Chipotle Mexican Grill, ticker CMG, has already announced its split, a 50-for-1 ratio with an X date on the 26th of June. Now, I highlighted this in last week's update and mixed up the ratio with Nvidia, but this is the company's first split in its 18-year public history, and Chipotle always seems to book surprisingly strong growth versus other quick-service peers like McDonald's and like Wendy's. Shares have already bounced 17% since that split announcement, so a lot of these pre-split gains might already be in place, and only long-term investors would want to jump in on this one. Booking Holdings, ticker BKNG, sports one of the highest stock prices in the market, approaching $4,000 a share. The online travel platform split its shares just once, back in 2003, so there is a history here. Now we're going to look at the prior splits in all these stocks to see if the board might be up to doing another, but stock splits just haven't been as popular over the last decade. They were big in the 90s leading up to that tech bubble, and then in the early 2000s, but are only just now starting to get more interest, so we could see this wave of stock splits extending for the next couple of years. AutoZone, ticker AZO, one of the three major auto parts stores, trades for over $2,800 a share. The stock split lasted in 1992 and 1994, but it's been 3 decades since. I've been following Advanced Auto Parts, ticker AAP, over the past year on its massive 60% sell-off in its shares versus its competitors AutoZone here and O'Reilly that have pretty well held up together. The average age of cars on the road reached a record 12.6 years recently, right in that sweet spot for mechanical needs, so they should support auto parts stores. Mercado Libre, ticker MELI, has bounced back from its post-pandemic sell-off and now trades for nearly $1,600 a share. The market leader for e-commerce in Latin America controls 21% of the total share, with strong leadership in Brazil, Argentina, and Mexico, though it has been seeing some erosion from competitors, especially Alibaba and some of the other Chinese platforms. The company doesn't have a history of splits, but is expected to see solid revenue growth of 32% this year and 23% next, so this is definitely one to watch anyway. Michael Saylor's MicroStrategy, ticker MSTR, is now basically a pure play on Bitcoin rather than a software applications company. The company now holds over 214,000 Bitcoins, worth $14 billion at the current price, so I guess that does leave about $12 billion in market cap that can be associated with its core business revenue, though that revenue, expected at $490 million this year, isn't growing that much, and the company's core earnings are deeply negative. MicroStrategy did hold a 2-for-1 stock split at the height of the dot-com bubble in 2000, only to reverse it with a reverse split of 1-for-10 when its stock crashed in 2002. I'm not sure the priorities are the same with the board here, so not sure if the company would be as open to a stock split now, but it does seem to be hooked into that investor trend, so that puts it on the list. First Citizens Bank shares, ticker FCNCA, is a fairly large regional bank at $26 billion market cap and branches across the South and West Coast. With shares trading just over $1,600 each, it's done surprisingly well, even in the banking crisis over the last 2 years, and shares aren't expensive here at just 1.14 times book value, but the stock has no history of prior splits. Fair Isaac Corporation, ticker FICO, with its shares just under $1,400 each, is the most frequent splitter on the list, having split its shares in 1995, 2001, 2002, and 2004. The credit scoring and monitoring software company has a dependable revenue growth around 13% a year, along with strong earnings growth, expected up 21% annualized pace this year and next. Shares are pretty richly valued here, though, at 58 times this year's expected earnings, but that dependability deserves a higher multiple, and FICO is probably my top pick for most likely to split. Lam Research, ticker LRCX, just announced its measly $2 per share dividend on a $1,000 stock price, but could reward investors with more shares in a split. The company last split in 1993 and 2000, so there is a history there, although it's been a while. The semiconductor company has seen its shares more than double over the last 2 years, so it would be following in Nvidia's footsteps here with a split on the stock. Deckers Outdoor, ticker DECK, is also one of my top picks for likely split candidates here. The shares, now just over $1,000 each, have jumped 283% over the last 2 years, so it's that kind of rapid growth that has priced out a lot of investors. The company also has the most recent split history, splitting 3-for-1 in 2010, so much of the current board should still feel the same way about the strategy. Footwear isn't exactly a high-growth industry, and shares are a little expensive at 35 times price to earnings and 6 times revenue, versus maybe something like a Nike for 27 times PE and 3 times its sales. So you want to do your research here if you plan on holding it long term. Also, just over $1,000 a share here is Regeneron Pharmaceuticals, ticker REGN, with no history of splitting its stock, but a steady 272% return over the past 5 years that might convince the board that the shares have run too high on that price. Regeneron is one of the largest biotechs at $114 billion market cap, has a steady revenue, and is profitable, something you don't see in these smaller players in drug development. Now for the stocks I'm watching this week, electric vehicle stocks could be getting some very cheap competition, whether they like it or not, with China sneaking its cars across the border. After President Biden increased tariffs on Chinese EVs from 25% to 100%, Chinese makers have ramped up production in Mexico. Chinese EV imports from Mexico surged 443% in the first quarter from last year. It's not just direct imports either. Chinese company BYD doesn't sell in the US and is keeping quiet on any plans, but does sell the 21,000 Dolphin in Mexico, where China EVs now control 86% of all electric vehicles sold. BYD announced a new model in February that could be as cheap as $14,000 and is exportable to the US. By comparison, the cheapest EV in the US right now is the $30,000 Nissan Leaf. So it seems China is adopting a two-pronged strategy here, selling in Mexico and letting US dealers drive those cars across the border, and also setting up manufacturing to import without the tariffs as part of that free trade deal. China EVs are basically nil for the US market share, but the strategies have worked to flood other markets across Latin America, Europe, and Southeast Asia. And it's not just the US here. The EU threatened an additional 38% tariff on EV imports last Wednesday as part of a year-long investigation, but China was ready for it. It's already started building manufacturing in Europe, as well as the countries like Thailand that might not be subject to those extra tariffs. I'm also watching Arbor Realty Trust, ticker ABR, now the most heavily shorted real estate investment trust, or REIT, with 54% of its available shares borrowed and shorted in the market. With nearly 2/3, 64% of the shares also held by institutional investors, it could set the stock up for a short squeeze if interest rates do come down. You see, folks, multifamily investors took out floating rate loans when mortgages were around 4%, but are now in trouble after those rates have doubled to 8%, and short sellers are betting that ABR has to write down the value of its loans and see its defaults to increase. As a mortgage REIT, ABR borrows on short-term rates and then leverages that money to buy those mortgages as investments. According to industry researcher Green Street, multifamily apartment valuations are down 26% over the last 2 years on that increase in interest rates. Shares of Blackstone Mortgage Trust, ticker BXMT, have plunged 23% since the end of the last year, but ABR is holding up, down just 11% over that same period and flat over the last year. Arbor has been more aggressive at modifying its loans to let those borrowers extend and avoid those defaults. This kind of extend and pretend is going on everywhere in banking, and short sellers are betting that it can't go on forever. If interest rates do come down, though, real estate is going to start to recover, and those shorts could be in for a rude awakening as they have to cover their bets. SoFi Technologies, ticker SOFI, has dropped to nearly a one-year low as investors worry about growth in the company's lending segment. One person not worried, though, is CEO Noda, who bought an additional 30,000 shares last week at a $6.48 per share price. Noda has bought more than 180,000 shares in the last year alone, and now has a position over 8.1 million shares worth $52.5 million. Now, that is a surprisingly large chunk for a CEO, especially one with a relatively small company. Noda owns nearly 0.75% of the total company for a strong vote of confidence in its future. All you out there in the Bowtie Nation know SoFi is one of my favorite forever stocks, and valuation is very good at this point. Showing you that bigger picture here with the sector spider tracker, just 3 of the 11 stock sectors closed higher last week, showing that the market was not nearly as strong as it seemed. Stocks in the real estate sector did do well on a drop in inflation and interest rates, giving investors hope that rate cuts could come and save property prices. It was in technology, though, that we saw the strength that lifted the overall index, with 40 of the 65 stocks in the tech sector rising. Semiconductor stocks including Broadcom, Skyworks, Supermicro, and Nvidia did especially well. Now, even after last week's rise, stocks in the real estate sector are still down 3.8% for the year, and they continue to slowly accumulate more shares of these REITs and the sector spider ETF, the XLRE. Property stocks aren't going to make you rich like tech, but valuations are extremely attractive here, and the market is bottoming ahead of eventual rate cuts. Folks, don't forget that after the 2008 crash, REITs were some of the best performers for years. I believe we're going to see that same replay over the next few years as real estate rebounds. Be a part of the Let's Talk Money investor community and get a piece of the monthly revenue from this channel. Click through the Gigastar in the video description and buy shares in the channel, generating over $60,000 in revenue a year. Or click on the video to the right for the 5 AI stocks Nvidia is buying right now. Don't forget to tap that subscribe button and click the bell notification.